I would like to welcome you to this chapter 9 about free cash flow models. We see on the next slide the content of this chapter. So we begin first with an introduction. Then we will discuss the free cash flow to equity models, and then afterwards the free cash flows to firm model. So with the free cash flows to equity model, the expected free cash flows to equity are discounted back with the expected return of the shareholders to get then the intrinsic share value. While if you use the free cash flow to firm model, then the expected free cash flows to firm are discounted back with the weighted average cost of capital. That's then the expected return of all capital holders, including debt and equity holders, to calculate then the enterprise value. And from the enterprise value, we add then the market value of the non-operating assets and deduct from that then the market value of the interest-bearing debt to get then the intrinsic value of the equity. And the intrinsic value of the equity can then be divided by the number of common shares outstanding to get then the intrinsic share value. And then we discuss the adjusted present value model. The adjusted present value model is a further development of the free cash flow to firm model. So with the adjusted present value model, we can calculate the enterprise value, determining first the value of the unlevered company, and then we add to it the present value of the tax benefits because interest payments are tax deductible. Typically, to calculate the enterprise value, then also the present value of the expected bankruptcy costs are deducted from the value of the unlevered company and the present value of these tax benefits to get then the enterprise value. So the adjusted present value model, in other words, takes into account the trade-off that the firm has with debt. So the advantage of that is that interest payments are tax deductible, and therefore a tax benefit does arise from debt. On the other hand, the higher the debt to equity ratio, the higher the level of indebtedness, the higher is then the bankruptcy risk, and that lowers then the value of the company.